Most people think life insurance is just about dying, but what if the real crisis hits while you're still alive? Welcome to the part of financial planning nobody talks about at dinner, but probably should. Here's the uncomfortable truth. Roughly 70% of Americans over 65 will need some form of long-term care, and the average nursing home costs over $100,000 a year. That's not a rounding error. That's your retirement savings evaporating while you're still breathing. The catalyst here is actually a collision between two broken systems: health insurance that stops at sick, and life insurance that only pays when you're gone. Somewhere in the gap between those two worlds, a very clever product was born: life insurance with living benefits. Think of it like a Swiss Army knife, where the blade you always use was the one for dying. But it turns out there's a can opener, a corkscrew, and a tiny pair of scissors hiding in there too. Chronic illness riders, long-term care riders, and accelerated death benefit riders are all variations of the same radical idea. Access your own death benefit before you die. The difference between these riders matters more than most agents will tell you. A long-term care rider typically runs on a reimbursement model, meaning you pay out of pocket and get paid back, while a chronic illness rider usually accelerates a lump sum or monthly portion of your death benefit. No receipts required. Now, here's where the optimism of the early 2000s meets the cold shower of reality. People bought these policies assuming premiums would stay stable, but many hybrid long-term care products saw rate increases of 40 or 50% over time. The promise was elegant. The fine print was a workout. But here's the irony that keeps financial nerds up at night. Traditional, standalone, long-term care insurance is basically a dying product, while life insurance with living benefits is quietly becoming one of the fastest growing segments in the industry. The insurance companies figured out that people hate paying for something they might never use. So they bundled the "what if I live too long" with the "what if I die too soon." History actually gives us a roadmap here. Every generation discovers that the cost of doing nothing is always higher than the cost of planning, and the ones who structured policies in their 40s paid a fraction of what those in their 60s scrambled to afford. We've seen this movie with disability insurance, with long-term care, and now we're watching the sequel play out with hybrid life products. The misconception that stops most people cold is thinking you have to be terminally ill to access these benefits. But chronic illness riders typically trigger when you can no longer perform 2 of the 6 activities of daily living, like bathing or dressing, or when you have severe cognitive impairment. That's not a death sentence. That's a Tuesday after a bad stroke. The practical structure that works best for most people is an indexed universal life policy, or a whole life policy with a long-term care or chronic illness rider added at issue, because adding it later is either impossible or painfully expensive. You want to build this in your 40s or early 50s, when your health qualifies you for preferred rates and your premium dollars go the furthest. Position size matters enormously here. You don't need a policy that covers every single dollar of potential care. You need one that covers the gap between what your income and assets can absorb and what a catastrophic care event would actually cost. A disciplined, unemotional approach means you're not buying fear, you're buying a specific, calculated hedge against a statistically probable event. The philosophical truth underneath all of this is that the best financial moves are the ones that remove the most catastrophic outcomes from the table, not the ones with the highest theoretical upside. Discipline, sizing, and consistency in your planning will always outperform conviction and timing. And honestly, there's a quiet comfort in knowing that whether you need the benefit or you don't, the money either funded your care or passed to your heirs. The policy wins in both directions. That's not a sales pitch. That's just elegant engineering. Whether you're exploring life insurance structures, real estate investing, home renovation projects, or connecting with the right lenders, check out our links in the description below and let's help you build the plan that actually fits your life.